right now the 10-year yield at 4%, I think isn't a huge burden for not only for the government, but also for the economy or for companies. So I think it's a level of funding that businesses can earn a return on capital. And then as we think about 2026, there's a lot to be excited about. We have deregulation coming. We have the tariff debacle behind us. We have tax cuts possibly. And then we might have better trade partnerships with other countries, meaning U.S. companies have earnings upside. I think that the market is flat year to date through May. So I don't think anyone should feel like they missed anything. I think that they're going to have a chance to buy a lot of companies. A lot of stocks got obliterated. And I think that these washed out names are still opportunities.
Tom Lee begins by addressing a question that's been hanging over the markets. Were the recession fears overblown? According to him, the answer lies in three key indicators that proved remarkably resilient.
Please take a little time to like this video, subscribe to the channel, and turn on post notifications for more videos like this. You can also check out our other videos on cryptocurrencies and the overall digital asset space and drop your comments and observations in the comments section below. Everything you do helps with the YouTube algorithm and immensely contributes to the channel's growth. Thanks and enjoy the video.
Zero is always a possibility, Brian, but I think it comes down to three things. The first is the high yield market never confirmed the panic that we were seeing from the economists about the economy. High yield spreads did widen to like 439 basis points wide, but if we were barreling into a recession, they'd get to 700 or so, and they're back down to like 360. The second is that the stock market did have a liquidation event, as you point out, but waterfall declines, all of them, 17 out of 18 since 1950, had a V-shaped recovery. So we knew that whenever the bottom was established, the bottom would be a V-shape. 2022 was the only real exception because of Jackson Hole. And the third is we had a lot of faith in businesses. These companies have been battle tested. They survived a pandemic shutdown. They survived a bullwhip effect from a recovery. They survived the fastest rate hikes in history. So I think that businesses really should get credit, and they've delivered earnings even for Q1 and for guidance that have been way better given the Armageddon that we expected. So I think those three things are the reasons we sort of told our clients to kind of buckle down and even add exposure. Yeah, I mean, there's a couple of factors at work. We were highlighting it during the tariff dislocation, but we know that the equity professional universe of investors, looking at political surveys, more than 60% are Democratic leaning. So their interpretation of the actions of the White House was half empty. So we saw an exaggerated move in equities relative to the bond market, where in the bond market it actually is flipped. In the fixed income world, 60% of bond managers are registered Republicans. And so that's why I think you get better signal, at least in this instance, from what the bond market was doing. And the second is, of course, something people have talked about is the 10 best days. We were highlighting this multiple times that if you exclude the 10 best days of 2023 or the 10 best days of 2024, the S&P only returned 3% a year each of those years. So you needed to stay in the market, as you point out, in order to get the 20% gains. And I think this year is another example of people rage sold at 48.35, and now they're buying in today. They missed 1,000 points or 20 percentage points of a gain in 2025. Yeah, I've got a couple of pieces of advice. I mean, right now the 10-year yield at 4%, I think isn't a huge burden for not only for the government, but also for the economy or for companies. So I think it's a level of funding that businesses can earn a return on capital. And then as we think about 2026, there's a lot to be excited about. We have deregulation coming. We have the tariff debacle behind us. We have tax cuts possibly. And then we might have better trade partnerships with other countries, meaning U.S. companies have earnings upside. I think that the market is flat year to date through May. So I don't think anyone should feel like they missed anything. I think that they're going to have a chance to buy a lot of companies. A lot of stocks got obliterated. And I think that these washed out names are still opportunities. And we talk about it with our clients, whether it's Tesla or the Mag 7 or the small caps, there's many opportunities still.
Ultimately, what we see is the evolution of Bitcoin from being sort of a tech asset tied to the Mag 7 or tied to the NASDAQ to something that's more akin to digital gold. And as that starts to happen, And I predict that will happen as wallets expand. Let's say there's roughly 300 million or so wallets for Bitcoin right now. Imagine a world where there's a billion wallets, a billion holders. The volatility should dampen. That happened in Microsoft. That happened in things like Google over a 20-year period of time. And so you could see a scenario where more wallets, lots of institutions in the mix, long-term holders, dampening volatility, and then you have this positive flywheel where the volatility is dampened by long-term holders who are owning it in size, and so therefore that reinforces the idea that other long-term holders should come in. I guess the big thing you have to ask yourself, is Bitcoin an investment or is it an asset class? If it's an investment, then $1 to $3 trillion, that sort of makes sense. That's akin to a Mag 7 market capitalization. But if it's an asset class, then it should trade to closer to where gold is, and I think gold's, I don't know, $22, $23 trillion right now. I would focus on Solana for right now because you have an ETF out there. It's SolQ, S-O-L-Q. Those guys at 3iQ were the first to launch a Bitcoin ETF in North America, the first Canadian ETF. We own a lot of Solana, just full disclosure. And again, full disclosure, we at Skybridge are investors in SolQ because we like that exposure. We also like the staking component to Solana, which you think is very good. So it's just a great way to get in there. Those other ones are going to be good, Avalanche, Polkadot, et cetera, but Solana.
Lee introduces a bold macro view. The U.S. has been in a rolling recession since the Fed began hiking rates. Now he believes we're exiting that phase and entering a new era of productivity-led growth. Evidence? He cites the FDA and the Center for Biologics Evaluation and Research using generative AI to analyze clinical studies in minutes instead of days. This is just one example of how AI is transforming operational efficiency across the public and private sectors.
President Trump certainly has an interesting way of negotiating, and our thoughts from the beginning is what he's looking for, and what I think we learned about with India today is to reduce tax rates as much as possible around the world, high tax rates, especially on the United States, to reduce non-tariff trade barriers. And I think we're beginning to see more and more of that prove out here. This is a global tax cut. This is a good thing. So we think the headwinds associated with what seemed to be chaotic decision making are beginning to clear. Well, we have been saying, actually, I just put out a letter talking about the rolling recession we've been in for the last 3 years since the Fed jacked up rates. We got a negative quarter in the first quarter, potentially in the second quarter as well. And I think more and more people are getting concerned about an extended recession and amid all the uncertainty. We actually think we're at the end of this rolling recession and that we are moving into a period after all of this uncertainty of much greater productivity. And interestingly, if you look at the government sector, we're seeing unbelievable productivity moves taking place. There's a video out there between the FDA, the new head of the FDA, and the new head of CBER. And they're talking about generative AI in reviewing studies, medical trials, that cut work from days to minutes. So there's a lot of productivity, I think, evolving in the ecosystem. I think companies are now enterprises. We see from Palantir that this is now a strategic decision for companies. So I think we're going to see a lot more productivity-driven growth, which means inflation is going to be much lower than expected, which is going to be very capital-friendly. We have always had a 2030 target, the base case in the 700 to 750,000 range, the bull case in the $1.5 million range. David Puel, our analyst and our on-chain analyst, put that piece out recently, and you can see the building blocks, how much share we expect Bitcoin to either take from gold or grow that store of value market. Institutions moving in, and they've barely moved in. We have 1 million more coins, roughly, to be minted ever. And institutions are just testing the waters right now. And then there's the emerging market use case as well. So we think we have miles to go, yes. As we have put out there, our target in 5 years, so 2030 again, is $2,600. And our confidence in that number has gone up now that Tesla is commercializing robotaxis in August, in June. What we don't have in that number, and what is happening faster than we expected, and as you know, we're very focused on learning curves and how quickly new technologies are going to evolve. Humanoid robots. And Elon has been talking about that market being bigger, ultimately, than the robotaxi market. And he talks about Tesla being number one globally when it comes to humanoid robots, and also says that China is number 2 to 10. So we have to get moving on that score as well. We think that's a $26 trillion revenue opportunity split between home and industrial in the next 5 to 10 years. It's going to be a huge market. And the reason Tesla is ahead of the game is we're talking about the three platforms it's already innovating on. Robots, robotaxis are robots. Energy storage, they will be electric. And AI. Those are the 3 technologies in the humanoid robot movement as well.
Tom Lee is making one thing abundantly clear. We're in the early innings of a long-term bull market. The recession fears? Overdone. The opportunity in stocks and crypto? Still massive. AI and automation? Unlocking an era of hyper-productivity that could suppress inflation and fuel earnings growth. Whether you're investing in Bitcoin, Solana, small caps, or tech, the time to buckle in, not bail out, is now. Because if you're waiting for certainty, you'll likely miss the breakout. Please like and subscribe.